Hi, everyone. So, welcome to the live stream today. Very much excited for having you as we continue with our discussion towards the ICAG May 2021 examination. We are in week 8 towards our discussion, and this week we are focusing more on the issue in relation to consolidated financial statement. This is section 3 of our discussion on consolidated financial statement, which is critical for corporate reporting students as well as financial reporting students. So in case you missed the session 1, session 2, then you can check the description to this video on YouTube. Check the description to this video on YouTube, and you'll be able to watch the playback of the session 1 and the session 2 as we build up on section 3 in that case. And you can also check the playlist that is called the group financial statement playlist on my YouTube channel, and you will get access to all of the content relating to consolidated financial statements so you can study and prepare well for your examination. I see some of you guys joining the stream. Welcome to the stream. This is part 3 of our discussion on the consolidated financial statement. So comment in the chat box any questions you have for me. What would you want us to cover more on the channel as we take our channel to another level this month and look at what we can do to assist you much better. I see some comments coming in on Facebook already. Let me look at them real quick. And I see some comments also coming in on YouTube. Let me see them already as well. Give us a thumbs up on the video when you join. It helps us a lot. It helps us so that YouTube and Facebook will be able to push the video so we can reach as many students as possible. So together we can assist a lot of students. So I see some comments coming in real quick. Let me look at them and let's go. Abdul Bimi Masahudu said, good evening. Good evening, Abdul. I hope that you are doing well. I think you've been part of the session throughout. Thank you very much for joining us. Maxwell K. Kwesi Apenkro said, good day. Good day, Maxwell. I hope that you're doing well. This is on Facebook. On YouTube, I'm seeing comments coming from Diaz Isa. He said, I'm enjoying the lectures. I'm watching live from North Legon. All right. Thank you very much for joining us, Diaz. Then Adolfo Stuya said, sorry if I don't mention your name well, but Adolfo said, hi. Hello, Adolfos. Welcome to the stream. I see some of you guys jumping on and coming in. Comment in the chat box if you have any questions for me real quick as I share my screen for us to get started with the discussion. So let me share my screen so we go straight up into our discussion. So let's see. Okay, so we connected. So yesterday we mentioned that I stated to you that there are 6 basic stages or steps or workings that we'll be looking at when it comes to consolidated financial statements. And that is the same thing I would want you to look out for as you go into the exam. So we mentioned that we'll be looking at a group structure. We've been looking at the net asset schedule of the subsidiary. We mentioned that we'll be looking at how goodwill will be calculated or computed. Then we mentioned the effects of intragroup transactions. And then we look at the group retained earnings. And most importantly, look at the non-controlling interest. So these are the 6 issues that we spoke about yesterday, that it is something that we need to spend more time on, need to dive a bit deeper on in that case. So these 6 steps, we want to take them one after the other, dive a bit deeper into them, solve some questions in them in that case. Now, I would want you to grab your calculators, get your calculators closer to you so that I didn't bring my Casio, because we'll be doing some calculations and you're going to be assisting me with the figures in that case. So let's go straight up into the discussion and then let's see what we can do. JCT said, hi, sir. How can I watch the past 2 days stream video you made? You can check the description to the video. You will see consolidated financial statement series, and then you can watch the full video for the part 1 and the part 2 there in the description. So the description to this particular video, JCT, you will see the past lectures there. Fadade Benga Emmanuel said, good evening, Nhyira. Trust you are doing well and keeping safe. Yes, and I hope you are as well. Another great time with you this evening. Thank you for staying dedicated and committed to this cause. More grease to your elbow. Always a pleasure, and thank you for joining us, Emmanuel. Right, so let me take you through, and let's go to section 3 of our discussion on consolidated financial statements. Ready? I see some of you guys joining on YouTube. You are welcome to the stream. Smash the like button on the video. Let's get more engagement on the video. Let me know where you are watching from as well in the chat, and also give us some message in the chat box. Let me know if you have any questions for me. So the key, we want to go through the key principles, okay? The key principles, and by extension, the workings that we're going to be looking out for when it comes to the consolidated financial statements. The key principles, then the workings when it comes to consolidated financial statements. So number one is the issue about the group structure. Now stay with me carefully here, because I'm going to be illustrating a lot of things in the group structure for us to look at, and so stay with me very carefully in that case. So that is the first thing obviously we're going to be doing when it comes to the preparation of the consolidated financial statements. That is the first thing obviously we're going to be looking out for. So usually the group structure is where we're going to be bringing the parent, okay, we slash it down, then we bring the subsidiary. Okay, now this is going to be the simple group structure, and then if there is an associate, it's going to be here. Okay, so what we are looking at first is simple group structure, because there is a complex group structure for corporate reporting students, and I'll be taking you through to that in a moment. So this is a simple group structure for our FR people. So here, let's say that we own whatever percentage. So let's say we own 80%, so that non-controlling interest is going to be 20% here. Now, if there is an associate, it means that we own less than 50% of the voting rights within the organization, and that is going to be the starting point. Now, still on the group structure, we need to be able to know two things: the date of acquisition, okay, and then the reporting date, so that we can know the post-acquisition period. So we must know the date of acquisition, the reporting date, and the post-acquisition period. Why is this important? Because the post-acquisition period will help us, which is going to be X over 12, will help us in the sharing of profit, computation of post-acquisition depreciation, dealing with the various items that we need to look out for when it comes to the fair value measurement in the subsidiary, as well as, if we want, in the associate in relation to that. So basically, that is the simple group structure for us to determine what exactly is going on. Now, sometimes the examiner is not going to be much excited about the exams, so he may not give you the percentage of acquisition by the parents directly from the question. In such cases, then, we would have to determine the percentage of acquisition directly as per the question given to us or provided us by the examiner. So let's crunch some numbers here, and let's look at how we're going to be calculating the percentage of ownership and then bringing up the group structure. So if you look at the question we have here, you realize that, let me zoom out a little bit to make it a bit bigger. Let me slash in my cursor somewhere. So you realize that we have on 31st December 20X8, Penn acquired 4 million of the $5 million $1 shares in Sylvania. That's all we want here. So Penn is acquiring 4 million shares of the 5 million of ordinary shares in Sylvania. So who is doing the acquisition here? Penn. So Penn becomes the parent company. So we're going to have Penn coming up. Let's use another ink, probably black. We've been using a lot of this. So we bring in Penn. They are having shares in Sylvania. And we don't know how many shares they own, but we are told they acquired 4 million of the 5 million shares. So that's going to be 4 million over 5 million times 100%. 4 million over 5 million times 100. I think that should give us 90%, I guess. Please confirm for me so that the non-controlling interest will be 10%. All right? The non-controlling interest will be 10%. Will that be 90%? I hope so. Can someone comment, confirm for me in the chat? Looks like it should be 80% instead, I guess. So confirm for me. I don't have my Casio calculator today. So should get 80% instead. Okay. All right. Thank you, Peter. Okay, so, okay. Edward has, Emmanuel also confirmed. Okay, thank you. So that is 80% and then 20% for the non-controlling interest in that case. So that is the issue about that. That is the issue about that. So in some questions, the examiner is not going to give you. In some questions, the examiner is not going to give you the ownership. So you have to be able to. You have to be able to know the percentage and then be able to determine the control. Now, in this question, we are given the date of acquisition to be, go back and pick it up, 20x8. Now, because this is just an extract, we don't have the dates, the reporting date for the entity. So I'm just going to be ending it there in that case. And we'll come back to this question later on. So stay with me. All right. So that is our simple group structure. Now, you remember that I told you something about associate yesterday. I told you that when it comes to subsidiaries, we're going to be doing full consolidation. But when it comes to associates, we are going to be doing what? Carrying it in accordance with the equity method, in accordance with IAS 8. So what's going to happen is that let's look at how we account for the investment in associates. Investment in associates. How do we account for that? Now, the way we account for the investment in associates is in accordance with IAS 28, using what is called the equity accounting. Using what is called the equity accounting, because the equity accounting is what we use to account for investment in associates. So with the equity accounting, what do? We slash in our currency sign, we bring cost of investment. Okay. Then we're going to be bringing the issue in relation to any post-acquisition profit or loss. If it is a profit, we add. If it is a loss, we're going to deduct. Then, if for any reason we receive dividend during the year from the associate, we're going to be deducting that. Then, if during the year also there is an impairment in our investment in associates, that will also be less. Please be careful about the impairment we are talking about here. Be careful about the impairment here. This is not impairment in goodwill. This is impairment in the investment we have in our associate. That is the impairment that we are bringing up here in that case. So, cost of investment, post-acquisition profit or loss, dividend received, any impairment in our investment in the associate, then provision for unrealized profit. Provision for realized profit. Now, there is a way this computation has to be done. And I want you to stay with me as we continue, because when we start to solve questions, I'm going to be explaining this in much detail later on. So you're going to be doing workings for this. Now, the way you deal with provision for unrealized profit in the associate is that you only take our percentage of ownership in them. Only take our percentage of ownership in them. And that is very, very critical in relation to that. So if the associate sold goods to the parents, and during the year under consideration, at the reporting date, the parent still has some of the inventories in stock, then the associate hasn't earned all the profit. However, the provision for unrealized profit we're going to be bringing here will be the provision for unrealized profit multiplied by our share of ownership, multiplied by the parent share in the associate. This is very, very critical, and I want you to make sure you don't mix this. I want you to make sure you don't miss this. So if the associate sells goods to the parent, and as at the reporting date, the parent still has some of the inventories in stock, then we have to calculate provision for unrealized profit. But with associate, when we are dealing with provision for unrealized profit, we don't bring the whole amount like we do in subsidiaries. We will take the percentage of the parent's ownership in that particular associate. That is the amount we are going to be lessing here. Let me know in the comment box, in the chat box, if this principle is clearly understood. So when we add up, we get the investment in associate value that will go to the statement in financial position. So this workings is to get a balancing figure going into the group statement of financial position. Please note that if we are preparing the income statement, dividend received is not what is taken to the income statement. Instead, it is the post-acquisition profit or loss that is taken to the P&L account. Again, if there is any impairment and we are preparing the consolidated P&L account, that will also go into the P&L account in that case. So that is the idea about this. That is the idea about this. So Benga Emmanuel said, not clear, please. What are you not clear with, Benga Emmanuel? Clarify that and let me explain. What are you not clear with? What exactly aren't you clear with? Benga Emmanuel. Put it in the chat, let me know. So that is how we deal with investment in associates using the equity accounting in accordance with IAS 28. In accordance with IAS 28. So you bring cost of the investment, you bring your post-acquisition profit or loss, you bring the dividend received to be deducted, any impairment in associate will be deducted, provision for unrealized profit, that is where the associate sells goods to the parent, and at the reporting date, the parent still has some of the goods in store, then provision for unrealized profit would have to be brought in that case, and we have to look at that workings about that. So that is simple group structure. Simple group structure. Now, from the simple group structure, you realize that everything is clear, everything is simple. In the determination of the group structure, there is no magical thing going on there. But what if we have Emmanuel, we are not dealing with subsidiary here. I see you saying, impairment workings to the subsidiary. We are dealing with investment in associates. We are dealing with investment in associates. So if we are dealing with investment in associates, the impairment we are bringing here is this. Let's say, for instance, A actually pays $2 million to acquire 25% in B, meaning that company B is an associate. Okay? If for some reason at the end of the reporting date or by the reporting date, our investment in them is no more $2 million, but now $1.8 million, that means our investment has fallen in value by $0.2 million. That $0.2 million is what we mean by impairment in the investment in associates. Does it make sense? That's what we mean by the impairment in the investment in associates. Silem Edward also is saying that I'm confused. Please let me know if it is clear now. So the impairment we are bringing here is not impairment in goodwill. It's not impairment in the subsidiary, but this is a fall in value of the investment of the investor in an investee where it has only significant influence and treating it as an associate in that case. Okay, Benga said he's okay. Silem Edward, let me know if you are also okay now. All right, you're welcome. How about complex group structure? Complex group structure. Now, stay with me carefully here. This is for corporate reporting students technically, but stay with me because we are still going through the principles. So stay with me. Complex group structure. This is for corporate reporting students. Selim said, I'm okay now. Welton Mbambara said, well understood. Thanks. You're welcome. So let's go. Now, when it comes to complex group structure, this is where a parent has a subsidiary and the subsidiary also has control of another company. So this is complex group structure. So we have subsidiary, we have sub-subsidiary. Stay with me carefully here as we build our knowledge in here. Now, let's say that the parent has 80%, just from our example, in the subsidiary. So the non-controlling interest here is 20%. Then let's say that the subsidiary the parent has also acquired control of another company and they have 75% ownership in them. Now, you have to be careful here because you don't just get up and say, the non-controlling interest in the sub-subsidiary is 25%. No, you don't do that. If you do that, that is wrong. We don't do that. So how do we get the non-controlling interest in the sub-subsidiary? The concept is that any investment the subsidiary makes, the parent company has its share of ownership of that investment. Let me take that again. Any investment a subsidiary makes, the parent entity has its share of ownership in that investment. For that reason, we would have to look at the controlling interest in the sub-subsidiary. Okay, so maybe let's put some companies up here. Let's say this is company B, this is company C. Okay, so we will look at the controlling interest in the sub-investment the subsidiary makes. The parent has its share of ownership in that particular investment. For that reason, the controlling interest in the sub-subsidiary will be the parent entity's ownership, 80%, multiplied by the ownership that the subsidiary has in the sub-subsidiary, 75%. This is what gives us the controlling interest. Please multiply up for me. Let's see what we got. 0.8 multiplied by 0.75. I'm getting 60%. You can confirm that for me. Please confirm that for me. So that non-controlling interest in the subsidiary will be equal to 100% minus the controlling interest of 60%. So the non-controlling interest in the subsidiary is 40%. This is how we deal with complex group structure. This is how we deal with complex group structure. Any questions for me? So like I told you, you don't get up and say, oh, because the subsidiary has 75% of the subsidiary, then NCI in the subsidiary is 75%. It's wrong. Because whatever investment the subsidiary makes, the parent entity has an equivalent share of that at the end of the day. As Timothy said, Nhyira, good evening. Please, the master class 390 Ghana Cedi, no? When is the classes, days and time, please? You can send hi on WhatsApp for details about our timetable, because I don't know the subject you are looking at. So you can send hi on WhatsApp 050 114 9296 050 114 9296. You send hi on WhatsApp and the timetable will be sent to you, Ahas Timothy, so that you know how you can get into it. But remember that you can enroll in the course online at 390 Ghana cedis per paper in that case. So that is how we deal with non-controlling interest in subsidiary. So as a corporate reporting student, you have to make sure that you understand, or advanced financial reporting student, you have to make sure that you understand this principle very well in how we get the non-controlling interest in the subsidiary. So that is our first workings one, getting the group structure. Remember, like I said, in getting the group structure, we are looking at the date of acquisition, the reporting date, the post-acquisition period. Not only that, if there is an investment in associates, we're going to be using the equity accounting, and we're going to be accounting for that respectively in that case. We're going to be accounting for that respectively in that case. So that is workings one. So let's go to workings two, the net asset schedule. Please note that these workings will be done if we are asked to prepare the consolidated statement of financial position. The workings I'm about to do will only be done if we are asked to prepare the consolidated statement of financial position. And note that the net asset schedule we are preparing here is for the subsidiary as well as the subsidiary. Nothing about the parent will appear here. It is solely for the subsidiary and the subsidiary if we have more than one subsidiary. So I'm going to pull up date of acquisition here. Then I'm going to pull up the reporting date here. So I'm going to work with two cash columns. Bring in my currency signs in that case. Bring in my currency signs in that case. So what do we bring? Usually, when it comes to the computation of the goodwill, this is very important, and also determination of the post-acquisition profit. So usually, we will just go to the statement of financial position given to us of the subsidiary and bring their share capital here. Usually, once an entity is acquired, is not going to be. As Timothy is saying that, please, is the registration token, please, is it from pay start? Yes, if you get to the payment page and you want to make the payment, the token will be sent to you for you to authenticate on your phone so that you can make the payments using the mobile money that you are using. So that is the authentication for you to approve and make your payments online. It has Timothy. So we bring in the share capital at the date of acquisition at the reporting date. Then we bring in any share premium they are having. Now, usually after a bit, we gain control of an organization. They may not issue any new shares. Hence, the stated capital at acquisition and at the reporting date will be the same thing. Now, I want you to stay with me carefully here from here. We'll bring the retained earnings. We'll bring in the retained earnings. Usually, the same figure at the reporting date will be at the date of acquisition. So at the date of acquisition, we bring the figure there, and that same figure will go to the reporting date so that we can have the profit for the year coming up. Stay with me carefully here. Now, with the profit for the year, what's going to happen is that if it is not a full, if it is a full year acquisition, then the profit for the year will go to the reporting date at the end of the year. But then, if it is not a full year acquisition, then we will have to share it so that a portion of that amount will come to at acquisition. Okay? And that is going to be X divided by 12 multiplied by the profit so that we can get a pre-acquisition profit. Now, let me explain this to you in that case. Stay with me. So let's say that the acquisition occurred on 31st March 20x5, and the reporting date is 31st October 20x6, 20x5, that's same 20x5. Then let's say that the subsidiary makes a profit of whatever, $2,000. Stay with me carefully here. Now, so what is the post-acquisition period? We realize that we have March, so April, May, June, July, August, September, October. So 1, 2, 3, 4, 5, 6, 7. So the post-acquisition period is 7 months. So there is a pre-acquisition period of 5 months. So what we are saying here is that since this is not a full year acquisition, the profit of $2,000 would have to be splitted between the pre-acquisition profits and the total amount to be taken to the reporting date. So if you check the amount you bring here, what I just highlighted is called the pre-acquisition profit. That is why I wrote X over 12 there. So that is 5 months. In my illustration, that's 5 months. So that's going to be 5 over 12 times $2,000. What do I have? 5 over 12 times $2,000. I'm getting 833. Can someone confirm for me as well? 833. 833. So this 833 is what goes to the year start, date of acquisition. Then the whole amount of 2,000 goes to the reporting date. So that's what we're talking about here. That's what we are talking about here. So if it is not a full year acquisition, then we have to split the profit and bring the portion of relating to the profit they earned before we came in to acquire them in that case. Okay, inshallah, Peter has confirmed 833. So that is what we mean by the profit for the year. So we bring in share capital, share premium, your retained earnings at the date of acquisition, the same will come to the reporting date. Then we bring in the profit for the year, and that's how we do the treatment on that. All right, now on Facebook, Nicola Sawini said, good evening, sir. I'm watching from Tumu. Okay, you are welcome, Nicholas. On YouTube also, I see some of you guys joining. welcome to the stream, and give us a thumbs up on the video, smash the like button. That way we get more engagement on the video, and YouTube will be able to push the video so we can reach as many students as possible. So that's the third thing. Then from here, we bring what is called the fair value adjustment. Now, this is where I wanted to stay with me carefully here as we begin to talk about the key principles and some of the key principles you need to understand. So when it comes to the fair value adjustment, at the date of acquisition, what happens is that the parent company revalues the assets of the subsidiary. Because yes, they've acquired them, they've paid the consideration payable, or they are yet to make the payment, but the assets of the subsidiary, assets and liabilities of the subsidiary of the sub will be revalued by the parent entity. Now, when the revaluation is done, it is either that the parent's revaluation is more than the subsidiary, or the subsidiary's revaluation is less than more than the parent's revaluation. So two languages can come up on here. This is where the examiner can say something like this, that at the date of acquisition, of the net assets or of the assets in the subsidiary are equal to the carrying amount with the exception of say an item of plant and equipment with fair value above or in excess of, then the examiner will put a figure there. So stay with me carefully here, because these are the illustrations you're going to see in the exam hall. At the date of acquisition, the fair value of the net assets in the subsidiary are equal to the carrying amount with the exception of, say, an item of plant and equipment with fair value above or in excess of this. Now, when we read this, what it then means is that the subsidiary had understated their assets, because if fair value of the assets, okay, is greater than the carrying value, it means that it results into what? A revaluation surplus. But that's not what we are looking at here. We are not looking at revaluation surplus, revaluation gain. But all we are saying here is that if they say above, it has to be adjusted in the net asset schedule. So fair value adjustment, we could have an asset and that is above or in excess. So if it is above or in excess, it means they had undervalued their assets. So above or excess, we add it back. But please note, since they had undervalued their assets, it means that for the year under consideration, they've charged depreciation less than how much they should have charged. Hence, anytime there is above or in excess about fair value adjustment relating to assets, and it is a depreciable asset, then we have to look at excess depreciation, which is going to take into consideration the post-acquisition period usually. And that will be subtracted here. I hope you are getting the picture so far. So if it is excess or above, it means the subsidiary had understated its assets. So since the subsidiary had understated its assets, the difference will now be added back to the net asset at acquisition and net asset at the reporting date. However, since the subsidiary had understated its assets, it means it had charged depreciation less than the amount which it should have charged for the period under consideration. For that reason, an additional or excess depreciation is charged, and that is brought to the reporting date and deducted. Now, the net of this actually goes to the consolidated statement of financial position as an addition. The net of the above figure less the depreciation will go to the consolidated statement of financial position, and we'll add it to property, plant, and equipment. Now, the reverse is true. What is the reverse? The reverse is simple. The reverse is that the same English could be spoken. Then we will have at the date of acquisition, the fair value of the net asset, blah, blah, blah. Okay? At the date of acquisition, the fair value of net asset are equal to the net, with the exception of, say, a land or a building, with the exception of a building with fair value less than with a building with fair value below or less than below or less in an amount of, so the amount to be given to us, I'm just trying to make sure that we get the amount aspect well. So here it says below, so we flip it up. If we value the asset and we realize that the fair value this time around is less than the carrying value, which means that is a revaluation loss. But again, we are not interested in revaluation loss here. What it then means is that the subsidiary had overstated its assets. They are carrying the assets in the books above the amount it is supposed to be carried. For that reason, we will have to less it up. So assets, if we have below, we will deduct it. We will deduct it. Then, because they are carrying the assets above its fair value or more than the amount at which they are supposed to carry it, there is going to be again an additional depreciation here. Which is still going to be based on the post-acquisition period. And this time around, you add it back to the profit. You add it back to the profit. You add it back to the profit. So that at the end of the day, the excess of this will be deducted from the consolidated statement of financial position. The excess of this will be deducted from the consolidated statement of financial position. I hope you are getting the picture very well. That is what you need to look out for when we talk about the issue in relation to above and below. Then, aside dealing with the fair value adjustment above or below, so comment in the chat box. Let me know if you have any questions about the explanation so far. If you have any questions, comment in the chat box. If you are watching on Facebook, put it in the comment box. I'm reading all of your comments and also looking at the chat box. So if you have any questions, don't hesitate to put it in there. Okay. Now, so apart from the fair value adjustments, there could be other adjustments in the questions. These other adjustments could be in a form of prior period adjustments. And usually these adjustments occurred at the reporting dates, and it could also occur at the year end. Okay, Henry Tete said I should take the fair value adjustment again. What we are saying here is that fair value adjustment comes in because after the parent entity acquires the subsidiary, they would want to revalue their assets so that per IAS 16, assets cannot be carried over the recoverable amount. For that reason, they would want to revalue the assets. So if they revalue the assets, two things can happen. Either that the fair value is more than the carrying value, in that case, meaning that the subsidiary is undervaluing its assets, or the fair value is less than the carrying value, in which case the subsidiary is overstating its assets. So what we are saying here is that where the fair value is in excess or above, it means the subsidiary is understating its assets. So if it is understating its assets, if we are looking for the net asset of the subsidiary, then we go and add it back. That is why we add back the excess or above. The same will be added at the date of acquisition and at the reporting date. Now, because they are undervaluing their assets, it means for the year under consideration, the subsidiary company will charge less depreciation than it should have charged. For that reason, we will make an additional depreciation for the excess depreciation relating to the post-acquisition period. So we calculate the depreciation. That is if the asset is a depreciable asset. That is if the asset is a depreciable asset. Then we will less it. The reverse is true. If the revaluation is done and we realize that their asset is below the carrying amount, below the fair value, that means that they are carrying the asset more than they are supposed to carry. Hence, in that case, when it is below, we will deduct. Now, since they are carrying the asset more than they are supposed to carry it, it means they will charge more depreciation than they are supposed to charge. For that reason, again, we calculate the excess depreciation, but this time around, it will be added back to the post-acquisition profit for the entity in that case, because they had charged more depreciation than they are supposed to have charged, taking into consideration the net assets of the company. So that is what we mean by the fair value adjustment. So Henry Tete Bariga, let me know if you understand it now. Then the next thing is the prior period adjustment. So there are other forms of adjustments that we need to look out for as we approach the net assets. So other adjustments that we need to look out for. The other adjustment, okay, Vincent Boster said, well understood, thanks a lot. Okay, you are welcome. So the other adjustment could be in various things. These are question specific. So I'm going to pull up some scenarios to you. Like for instance, in accordance with IAS 23, borrowing costs are expected to be capitalized if they are for qualifying assets. So we capitalize borrowing costs, qualifying assets. That is IAS 23. Now, if for some reason the subsidiary is not accounting for borrowing costs in accordance with IAS 23, in other words, the subsidiary is not applying IAS 23, when the parent acquires the subsidiary, immediately they would have to start the application, because on the face of the consolidated financial statement, we have to bring the financial statement of the subsidiary in line with the same accounting standards as the parent entity. For that reason, if, for instance, the subsidiary is not applying IAS 23, now that they have been acquired by the parent, we need to apply the IAS 23. What it then means is that instead of capitalizing borrowing cost, the entity may have been writing it off. So since they are writing it off, what we're going to be doing here is to now capitalize it. So whatever amount they have written off, reduced their net assets, reduced their group retained earnings. So such adjustments will be added back to the date of acquisition. And if during the year they have incurred some borrowing costs that they had also written off, we will come and add it back as well to the reporting date. This is what we mean by other adjustment. This is just one of the scenarios for other adjustments. This is one of the scenarios for other adjustments. So where the acquired entity, the acquiree, is not applying and treating transactions in accordance with certain accounting standards, it is required that the transaction will now be accounted for in line with the accounting standards used by the parents. That is what we mean by the other adjustment. And there could be other items in there. As you solve questions and expose yourself to questions, you could come across with other illustrations in that case. Okay, so that is just one illustration in there. So in that case, we're going to be adding it up. If, for instance, they are capitalizing on expenses that they are because they were using their local accounting standards, and in accordance with IFRS's, we are not supposed to capitalize that expenses, then it means we will come and write it off. In other words, we will deduct it from the date of acquisition in that case for the entity under consideration. So that is what we mean by other adjustments. Now, where the subsidiary sells to the parent, and at the reporting date, the parent still have some of the goods bought from the subsidiary in inventory. Some of the goods bought from the subsidiary in inventory, then quickly there has to be post-acquisition, provision for realized profit. So we could build that into the schedule here and bring provision for realized profit. Please note, like I said, when subsidiary is selling to the parent, that is where provision for realized profit comes here. When the subsidiary is selling to the parent, that is where provision for realized profit comes in here. Stay with me carefully here. Make sure you understand that. If the parent is selling to the sub, then the provision for realized profit will go to group retained earnings. But if the subsidiary is the one selling to the parent, and the parent still has some of the goods in stock at the reporting date, then the profit is not actually earned yet. For that reason, it will be deducted from the reporting date in that case. So once we have this, we close it up and we get a net asset. We get a net asset. Now, in that case, the net asset at the date of acquisition will be used when we are dealing with goodwill. So when we are calculating goodwill, we will use the net asset at the date of acquisition. Then the difference between the net asset at acquisition and at year end is what is referred to as the post-acquisition profit or loss. The post-acquisition profit or loss, so that will be shared between the parents when we are dealing with group retained earnings, and then there's non-controlling interest in that case. Non-controlling interest in that case. So that is the to net asset schedule. That is the workings to dealing with the issue in relation to the net asset schedule. Any questions, please? Any questions, please? So we've looked at the group structure, and take into consideration that in the group structure, we looked also at the workings of what? The investment in associate. Then when it comes to workings to the net asset schedule, remember I said you only do this schedule if you are preparing the consolidated statement of financial position. Consolidated statement of financial position. But then if you are preparing the consolidated statement of profit or loss, you may not need the two. You will only need the at the date of acquisition to calculate goodwill if the examiner asks you that. If not, then you will be good to go in that case. If not, then you'll be good to go in that case. So that is what you need to understand about that. Any questions for me quickly? That's working stew. That's working stew. So if we go back to our slide, we said group structure. That's the first thing we do. In the group structure, we look at the date of acquisition, the percentage of ownership, determining the non-controlling interest, both in a subsidiary and a sub-subsidiary. Then from there, you go to workings 3, and that is going to be goodwill. So workings 3, goodwill. Workings 3, goodwill. Right. Now, so for time constraints, I'm going to be concluding around here today, so that God willing, tomorrow we will continue with our discussion in relation to the consolidated financial statement. So I'm going to be concluding around here. Tomorrow it's going to be really intense, where we put all the pieces together, because now we will look at how goodwill is calculated. We will look at how we deal with the group retained earnings. We will look at how we deal with the intra-group sales, intra-group transactions, and that is very, very critical when it comes to dealing with consolidation. So God willing, tomorrow we're going to be continuing with the discussion, and that will be section 4, as we look at what it is that we need to do in order for us to understand the consolidated financial statement. So any questions, please put them in the chat box for me as we wrap up for today. And I'll be coming your way again tomorrow at 4:30 p.m. GMT for the part 4 on this. And we're going to be starting with goodwill computation. Then we will look at the intra-group transactions and look at the other things that we need to focus on in order for us to prepare well for the examination, and most importantly, pass the exams. All right. So thank you very much for joining the live stream. It's always a pleasure coming your way. Remember to subscribe to the channel if you have not subscribed to the channel, and click the bell notification icon, because that way, when I go live, you'll be the first person to be notified by YouTube, and also get the notification and join us as well. Remember that you can enroll in our full course and learn directly under my mentorship at 390 Ghana cedis per paper. All you need to do is to visit NhyiraPremium.com, select a subject, and after that, you reach us out 050-114-9296, 050-114-9296, and let's assist you and study under my mentorship for you to prepare well for the examination. In case you want to find out details about our courses and get access to all our course content, you can visit NhyiraPremium.com, and you'll see the course outline, you will see the course content, and how we break down everything in order to assist you to prepare well for the examination, and most importantly, pass the exams. I'll see you same time tomorrow at 4:30 p.m. GMT as we continue with our discussion. So you stay safe, stay blessed, and you take care of yourself. Bye-bye.